Hi guys, I'm Dan, this is Kai. We are the directors at Crescent Mortgages. Today we're going to be talking you through a really important part of the mortgage process, a decision that everyone will have to make, what type of mortgage scheme to go for. Fixed versus variable, short or long term, it could make a huge difference to how much you pay. We'll talk you through the pros and the cons and try and help you make your decision. And we will also be giving you a really important tip at the end of the process, which could save you a lot of money. So make sure you stay tuned until the end. Before we jump into it, just to remind you that we are not YouTubers, are we?
No.
We are mortgage brokers. So although we are here on YouTube trying to give you free, accessible advice to as many people as we can, we are specifically mortgage brokers, so we can assist you with your mortgage. So if you need any help, have any questions, want to start the process, need to run through the initial consultation so you can work out how much you can borrow, if you're eligible for a mortgage, and just talk through the process, you can get in touch. So send us a message, leave something in the comments, give us a call, and we will come back to you to talk you through the process. Mortgage schemes. One of the biggest decisions that people need to make.
Yeah.
There's lots of options. If you go online and pick yourself and you don't get advice, you could get things horribly wrong. And if you go directly to a bank, they won't always give you formal advice. Often they will just talk you through the different options and say, take your pick. But a lot of people, especially if it's the first time you've done this, don't always fully understand the implications of the decision that you make.
Yeah, and I guess when we come on to breaking more of it down into the mechanics of it, that will become clearer as we go on. But if you get it wrong, it could be thousands. And likewise, if you get it right, it could be in your favour. And
bear in mind as well that picking the correct scheme isn't just based on following the economy or predicting what's going to happen. It does largely depend on the market at the time. So obviously we're going to give you kind of an example based on the market when we're filming now, but obviously depending on the mortgage market and the economy and what's happening to interest rates, that could dictate what scheme you go for, and obviously your personal plan. So people can sometimes get caught up on the kind of the economics and trying to follow the market, but actually your personal plans for the property, how long you're going to be there, and also your attitude to risk. You might be a bit of a risk taker, or you might like to kind of go down the more sensible, safe bet. That all kind of comes into making the right decision on the scheme, doesn't it?
Yeah, people get contradictory, don't they? Often somebody has this life plan, but this economical opinion, those two don't necessarily work. And that's where advice comes into which is more important and the pros and cons.
So I think what we're going to do during this video, we're going to start by just giving you kind of a fairly brief overview of the different types of schemes, the most common ones that are likely to come up that you'll have to choose from. And it is ultimately your decision what scheme you go for. And then we'll start to break down kind of the pros and cons and try and really give you some help in making a decision for you. Bear in mind, obviously, that don't take this as formal advice. We do tailor our advice to every client specifically, but we will kind of go through and just talk you through the pros and cons to potentially help you make your own decision. There's a few categories and subcategories.
Yep.
I love that, don't I?
You've loved, yeah. Really
so
is.
The first decision you'll need to make is
fixed versus variable.
Yeah,
So we're
good,
starting,
good.
Fixed versus variable. Most people seem to have heard that question. If you're at this point, you've probably heard that question already, or a lot of people seem to have.
Yeah, and for most people, unless you're, not every lender offers every lender will offer a fixed rate. Some lenders offer variable rates, not every lender does. So obviously, if you're limited due to criteria to a small handful of lenders, it might be that you don't even, you don't have access to a variable rate because those lenders may not be willing to lend you to you for whatever reason. But assuming that you've got the whole market to choose from, you will have the option of either going for a fixed rate or a variable rate. You maybe already have an idea of how it works, but just to give the basics, what are they?
Well, variable is exactly that. It can fluctuate. It can go up or down, or it could stay the same in theory if nothing changes. But it will go up or down depending on various factors. A fix won't. A fix will remain fixed for a finite period of time.
So if you go for a 2-year fix, your rate is guaranteed to stay exactly the same for that initial 2 years. Doesn't matter what happens to the market or what happens to your circumstances, the rate, it cannot go up, it cannot go down. You know exactly how much you're paying for the initial period. Like I said with the variable, it can fluctuate, but if there are certain factors of the economy are stable, your rate could stay the same. The most common type of variable that we see and recommend is
a tracker. A tracker mortgage, which will follow the Bank of England base rate. And so if the Bank of England base rate goes up, the tracker will be above or potentially below that base rate and will follow it by a set margin.
So for example, if your tracker rate is the Bank of England base rate plus 0.5%, no matter what the Bank of England base rate does, your rate will always be 0.5% above it. And like I say, it can go up, it can go down, or there can be long periods where the Bank of England base rate stays the same, although it has been moving kind of fairly frequently over the last couple of years now, hasn't it? That's fixed versus variable. That's the first decision you'll need to make. The second decision you'll need to make is
the length of the scheme, really. And it's probably more applicable if you picked a fix. There are different lengths of variables, but in most markets over the last decade or two now, really, most people it's short-term variable or I guess lifetime variable. But generally speaking, you don't have much of a length of scheme on variables.
Yeah, like I said, it's generally, you'll probably get either a 2-year tracker where it will follow the base rate for the first 2 years, and then at the end of the 2 years, that scheme would end and you'd have to pick a new one, or a lifetime tracker where it will just stay on that tracker indefinitely until you decide to leave it, and you wouldn't normally be tied in on those schemes, so you can leave them whenever you want. The fixed rates, there are more length options, aren't there? So the two most popular that we see are a 2-year fix, so short-term 2 years, normally the shortest that lenders will offer, or a longer 5-year fix. Pretty much every lender will offer one of those two options. Some lenders offer somewhere in the middle, such as a 3-year fix. Not every lender does. And some lenders will offer even longer than a 5-year fix, such as a 7-year or a 10-year. We don't see or recommend them as frequently, but again, it does depend on your circumstances in the market. Some people might like the idea of long-term stability.
It's getting more popular to offer, lenders are trying to offer a bit more, aren't they? We've had a few 1-year fixes, 3-year fixes, 7, 10, lifetime fixes, more, but 90% it feels like the people at least probably have 2 to 5.
Yeah, exactly.
Generally.
So that's kind of an overview of the basic decisions you'll need to make. One point we do just want to cover here is what we're talking about now is the scheme. So if you go for a 2-year fix, or you go for a lifetime tracker, or a 5-year fix, that is a scheme, also known as a product, or you might hear it referred to as an interest rate. So it's essentially the interest rate that you're gonna be tied into, or kind of that will be fluctuating with the Bank of England base rate for a specific period. This isn't to be confused with term. Some people kind of struggle to get their head around this to start with, but it is fairly simple once you do. The scheme, as we've just mentioned, is the initial interest rate that you're going to go on for the next however many years. The term is how many years you spread the entire debt. So a common mortgage term for a lot of first-time buyers might be somewhere between 25 years to 40 years. So it's how long you spread the debt. Obviously, the longer the term, the lower your payments will be, because you're spreading it out, spreading the balance out. But with a longer term, yes, your payments will be lower, but because you're paying the mortgage over a longer period, you will ultimately pay more because you're paying more interest. And you'll have a mortgage to an older age. Whereas a shorter term, payments are higher, which obviously it maybe isn't as attractive to you, but you're going to have that mortgage clear quicker and ultimately pay less interest. So what will happen during the course of your 20-year, 30-year, 40-year mortgage term, you will have kind of successive schemes running across those years. So you might start on a 2-year fix for the first 2 years, then when that scheme ends, you'll need to shop around for another rate. So you might then select a 5-year fix for the next 5 years, and you'll do that every few years throughout the mortgage term. And every time you do that, it's called a remortgage. Every time you shop around and move to a new product, it's a remortgage. So that's the basics. Now, probably the reason most people are tuning in is kind of the pros and cons of each scheme and how to decide which one you're going to go on. So do you have any initial thoughts? I guess first of all, fixed versus variable, and the pros and cons, and why you might go for a fix or why you might go for a variable, because the reasons can sometimes be quite specific. So if you're watching at home, one of these points might resonate straight away, and you'll know that actually what one of the options of the two is right for you.
Yeah, no, definitely. I think fixed versus variable often feels like an easier one than the length of product for most people. The first clear and obvious benefit of fixed rate is you get stability. Most people are you're buying your first house or whatever it may be, trying to budget, many unknowns. If you know, right, my mortgage is fixed at this much for 2 years, 5 years, however long, that's an attractive proposition just to know what you're going to pay.
Yeah.
That's the biggest and most obvious pro of a fixed rate.
Yeah. Guaranteed payments, guaranteed interest rate. I think some people, you know, if this was an investment or it was your pension pot or anything else, you might be willing to take a little bit more of a gamble. I think for most people, the roof over their head, your residential property where you, maybe your partner, kids might live, you want something to be a bit more secure, don't you? Yeah. So I'd say there's no right or wrong, but the majority of people probably opt for a fixed scheme for that reason. I mean, that's not to say it's right, but we see the majority of people going for a fix for that exact reason. You've got guaranteed stability of payments. No matter what happens to the market, they cannot increase your interest rate for the duration of that initial scheme. However, and this is probably the main con of a fix, you are tied in for the initial scheme period. That's a really, really important part of your decision. And this is the bit that a lot of people seem to forget. If you go for a 5-year fix, and you might love the idea that you've got long-term stability of payments for the next 5 years, that's great, but you are tied into that scheme for 5 years. There are ways you can get out, but there normally are big charges, it's not cheap. So you do not want to go for a 5-year fix unless you know you're going to be on that scheme for the next 5 years. And we see a lot of people go for the 5 years, they haven't really thought about it, when actually in reality, they don't know how long they're going to be in that property. They might move in 3 years, in which case it could be quite expensive to do that.
And that's where we talked about the kind of personal and economical kind of balances here. That's the most classic example is I want long-term stability, but in 2 years I'm going to move because my kids get to this age and we want to relocate for schools, or a very specific reason. There's a big judgment. The charge to get out of a 5-year fix could be 2, 3, 4, 5% of your mortgage balance.
It's massive.
5, 10, 15 grand, like big numbers. So the money you've saved with a little bit of stability could be wiped out and multiplied massively.
And exactly what you just said there, that you could be so obsessed with the economic, I think this is going to happen. You might have your own opinion of what's going to happen to the market and what's going to happen to interest rates, and you've decided actually you want to go for a 5-year fix. But like Kai mentioned, the real world decision based on your personal and family plans, it doesn't matter what the market's going to do. If you're going to move house in 2 years, any saving you might have made making a savvy decision on the interest rate will be entirely wiped out with potentially a 10 grand early repayment charge to leave it early. So that's obviously the con of fix, is you are tied in for that initial scheme period.
I was going to say, there's probably one more con that it's only really been a con since rates shot up in 2022? Is that what happens if you take a fix and rates drop? That's not, from 2007, 2008 until 2021, 2022, that wasn't really a thing because rates stayed low for so long. But with them being higher and probably more normal for a long time, there will be patches where rates might drop unexpectedly or suddenly, and vice versa, they'll shoot up.
People are you're terrified you're going to fix in for 2, 3, 5 years on a rate, stuck on it, you can't get off it, and then suddenly rates improve and all your friends are getting better interest rates, which I guess ties in with my previous point that because you're stuck on it for 5-year fix, you're stuck on it for 5 years, you're not going to be able to keep an eye on the market. If rates improve in 2 years' time, but you're on a 5-year fix, you're not really going to be able to move on to a lower rate without taking a hit on that huge fee. But you're absolutely right. You have less ability to kind of keep an eye on the market, which kind of ties us over to variable rates, which in a way, in some ways, are the opposite pros and cons, but not exclusively. So the main pros of a variable rate are, not all of them, so you have to check this, but a lot of variable rates do not tie you in. So you might go for a 2-year tracker. So a 2-year tracker, the type of a variable rate that follows the Bank of England base rate. So even though it's a 2-year scheme, some of them do not tie you in for 2 years. So if in 12 months, halfway through that 2-year tracker, you want interest rates improved and you wanted to move over to a fixed rate, you could without being charged. And if you wanted to move house halfway through that tracker, you could without being charged. You could just redeem the mortgage and they're not going to charge you anything at all, other than potentially a tiny admin fee to close the mortgage down. So that's probably one of the main reasons why we see people moving onto a tracker is the flexibility, isn't it? Some people, if you don't know what your long-term plans are, and you tell us you might move house in the short term, we often will discuss variable rates with you to give you that flexibility. The downside is that you do not have any stability. And if interest rates go up during that scheme, if the Bank of England, if you're on a tracker and the Bank of England base rate goes up by 0.5%, your interest rate is going to go up by 0.5%. So stability of payments, which is important to a lot of people, you will not get with the tracker.
And if you think, I know again, you go back 10, 15 years, base rate didn't do too much over those time, but between 2021 and 2020... Do
you want to get that? Where were we?
From, 2021-ish, rates started creeping up. The base rate got to 0.1%.
Yeah, it was ridiculously low for a little while.
I think it was 2021. The aftermath.
You lose track of time, don't you?
You do a little bit, But from there, it's peaked at, likely peaking at 5.25 I mean, that could change
at time of filming,
depending on when you see this and what happens. But there was over a 5% jump in probably 2 years, 18 months. That's huge. And if you're on a variable, when it was at 0.1, at 1% above the variable, which some people would have been,
where your mortgage payments would have been rock bottom.
Exactly.
And you'd have been absolutely loving it for a little while.
But that quickly changed.
Yeah.
And some people would just try and ride out, hopefully it comes down because fixes were more expensive and it was hard to, when do you jump off, when do you commit?
Or some people aren't even aware of what rate they're on.
Exactly.
And they're buried your head in the sand, don't know what's happening, realising that your mortgage payment is going up every month as the Bank of England base rate goes up across 2 years.
So it can be really volatile, particularly if you're in a low base rate or low interest rate market. The risk of obviously going up is greater than if you're in a high rate market where maybe more expenses go down. So that's the biggest con, is that lack of stability, possible fluctuations, which weirdly is also one of its pros. The fact that it can come down.
Yeah, because and the pros of the variable, yes, it can come down. And I guess the beauty is with the variable, if the market improves or fixed rates drop, you can move on to a fixed rate.
You got a choice, haven't you? You let it ride down for longer, or you jump off at a fix if you think that's as low as they're going to get now.
So again, more flexibility. So that's pros and cons of the fixed versus the variable. And then if we come over to probably the hardest, most people know if they want a fixed or a variable. Or once we've had the conversation, it becomes quite clear what's right for them. The biggest decision is how long your scheme is. So let's assume, let's say you've decided to go for a fixed rate. You can, as we touched on earlier, 2-year fix, 3-year fix, 5-year fix, or something even longer. And there are clearly pros and cons of each. The variable I don't think is as applicable with this conversation because, like I say, you only really get a 2-year tracker or a lifetime tracker. Lifetime trackers are quite rare, but because they are higher than normally 2-year trackers in the current market. But again, if we focus on fixed schemes for now, assuming you're going to go for a fix. So how long are you fixing for? So if you go for a shorter fix, you're not going to get as long stability of payments. In 2 years' time, you're going to have to reassess everything, potentially do another remortgage, and you don't know what the market's going to look like. So obviously, there's always a little bit of a gamble there. But the 2-year fix is going to give you, on the flip side, it's going to give you the freedom in 2 years' time to shop around. And if rates have improved, you can move on to potentially a lower rate. But again, you never know in advance. And they do give you a bit more flexibility because in 2 years' time, if you want to move house, if you want to remortgage and borrow extra money, you've got the freedom to play around with your mortgage or sell the property in 2 years. And
the repayment charges are smaller as well, generally on the shorter fixes.
So if you did pay it off
even
early,
if you had to pay it off early,
it might be a bit less.
It's still a useful amount of money, but it's less.
Compared to a 5-year, where basically the exact opposite. You've got long-term stability, you don't have to stress, you don't have to worry about remortgaging, you don't have to worry about what's going to happen to the market or interest rates. You've got long-term stability, you can just sit there for 5 years and leave your mortgage alone. Or if you've got a 7-year fix, you can sit there for 7 years and just leave your mortgage alone. But no flexibility. You're stuck for that period of time unless you pay a hefty early repayment charge. And if you want to move house, if you want to make any changes to the mortgage, if you want to remortgage because rates have got lower, you're not really going to be able to do that. So very much kind of pros and cons. Now, what's right for you? There's a few factors. I mean, first of all, the market when you apply for the mortgage, that will obviously be a factor to what decision you make. I guess we can maybe just give an example of the market we're in right now, but bear in mind the market has been volatile. If you watch this video in 3 months, 6 months, 12 months, may not be exactly what we're looking at now. But for example, right now, fixed rates have been volatile. They've jumped up recently, so fixed rates are quite high relative to where they were a couple of years ago. The base rate, the Bank of England base rate is even higher than fixed rates right now. We're hoping and potentially expecting that they're both going to come down at some point in the future. We think maybe fixed rates are going to start to creep down, and a lot of forecasts suggest that the base rate, currently at 5.25, has peaked. So unless something unexpected happens, we don't think it's going to keep going up. Hopefully might start to drop later in 2024. So the pros and cons, I mean, some people maybe go with the logic that they want to go for a variable rate because they think rates are going to come down. So,
which makes sense. When you say it aloud, that makes sense.
There's logic in it. There is logic, and on the face of it, you know, if you're going on a rate that's going to follow the Bank of England base rate, and you're expecting the Bank of England base rate to fall, logically you think, well, yeah, maybe put myself on a variable. The problem is, as I touched on, the Bank of England base rate and the trackers, because your tracker won't normally be exactly the Bank of England base rate, it will normally be the Bank of England base rate plus a percentage, whether it's plus 0.25, 0.5. So if you opt for a tracker right now, it will be higher than if you opt for an equivalent fixed, 2-year tracker versus 2-year fixed.
Yeah.
So when the mortgage starts, you're going to be taking a hit for the first few months, paying extra interest on a tracker than you would be if you're on a fix.
Yep.
Obviously, the intention is that eventually the Bank of England base rate is going to start to fall and your interest rate and payments will fall as well. But we don't know exactly when that's going to be.
No,
and we don't
no
know,
one does.
No one knows exactly when the base rate's going to fall. It could be
does.
stubborn, it could stay where it is for longer than expected. And even when it does start to fall, it's probably not going to just fall by 2% overnight, is it?
No, highly unlikely.
It will come down in potentially small increments, which might not be every month. So yes, the base rate, your rate might eventually go down, but in the time that you've waited for it to go down, you may have paid more interest than you're going to say back in the subsequent months after it's dropped. So we're not saying you shouldn't go for a variable, but it's not always as simple as just thinking, okay, the base rate's going to drop, so let's go for a variable.
Yeah, exactly that. Yeah, you're right. Yeah. No, and every single point there was right. It's the how. Yeah, you're welcome. How big that gap is between fixed and variable is basically the conversation that we would end up having. If you come to us and you say rates coming down, I want a variable, I've seen your video, whatever it may be. If we then tell you it's 0.75 difference in a variable and a fix, for 2 years that needs to come down 0.75 to get you level and then fall by a certain amount to make you start winning. And depending on what the market looks like for all sorts, economically that's a tough decision to be sure on.
Yeah.
It's an impossible decision to be sure on.
And I think maybe and then the final example we want to give you, and then we're going to jump onto the tip at the end, which make sure you stay tuned, because we tell every client this, not every broker does, and this in the current market especially could save you a lot of money, so make sure you stay tuned. The final one, which is probably the most common scenario that we discuss with clients in the current market, the example we've given you, but it's how long to fix for. So a lot of people are looking between a 2 and a 5 year fix.
Yeah.
Some people, because they've seen rates jump up over the last few years, they may be concerned that they might continue to go up, and so they want to opt for a longer 5-year fix to give them stability. And more importantly, in the current market, this never used to be the case, but because of how the market's flipped, 5-year fix rates now give you a better interest rate than a 2-year fix. So if you opt for a 5-year fix, you're going to start with a lower interest rate and payment than if you go for an equivalent 2-year fix, which naturally looks more attractive.
Yeah.
Of course, you want the lowest interest rate, but just bear in mind with that 5-year, yes, the rate's a bit lower now, but rates are still quite high, and you are going to be stuck on that rate for the next 5 years. Whereas the 2-year fix, yes, you're going to pay a slightly higher interest rate for the first 2 years, but there is a chance in 2 years' time that you could get a lower rate when you remortgage. Now, we cannot guarantee that. Very much depends on the market. Unexpected things could happen, but that's the logic that a lot of people are using. So don't just get sucked into, some people without getting advice will just say 5 years is lower, I'm going for the 5-year, not fully kind of thinking through the long-term plans of how much that might cost you in the long run.
Yeah, if rates plummet, then your 5-year doesn't look like such a good decision, potentially. But if rates are stubborn and remain similar for 2 years, then your 5-year looks like good. It's
just largely your attitude to risk and how safe,
exactly.
the safe bet, or do you want to take a little bit more of a gamble? The final tip, this is one that we really want to get in there, because I don't think we've mentioned this in other videos really in detail.
No, but we've been talking about it properly for...
So when you apply for a mortgage, you will lock in the interest rate upon application. So when you've passed the credit check and we submit the mortgage application, you lock in the rate. So even if interest rates increase after that, it doesn't matter. That's the worst case, that's the rate that you're going to get. Even if you apply for the mortgage and then 2 weeks later, Bank of England base rate goes up, lenders all hike their fixed rates up by 1%, you've locked in the rate upon application. So as soon as you apply, you get that security. As we mentioned, afterwards, if rates go up, doesn't matter. But if you're in a market like time of filming, where we're hoping that fixed rates are going to creep down, when you apply for the mortgage, on average, it might take 4 months from applying for the mortgage to getting the keys moving into the property. Can be longer, can be shorter, on average about 4 months. In that 4 months, if the market improves and interest rates drop, you are not committed and stuck on the one that you've locked in. We can assess the market and drop you over to a lower rate between applying and getting the keys, which I say that could be a 3, 4, 5, 6 month period. So a lot can happen in that time. Make sure, If you deal with us, as I say, we can assist you with your mortgage. We will have that conversation with you to make you aware that you have this opportunity. If you deal with another broker or direct, make sure you speak to the lender when you're approaching exchange of contracts at the end of the process. So when you're getting close to getting the keys.
Yeah, a few weeks or so before. You don't want to do it too tight, otherwise.
Yeah, because if the lender does need to do,
you don't want that.
Yeah,
but
sometimes they can switch the rate just there and then. It can be very quick, but sometimes if you make the amendment, the case might go back to be assessed. They might ask for a few up-to-date documents. It can happen, so don't leave it right until the last minute. But let your broker or bank know when you're approaching exchange and ask them to do a rate check for you. If rates have improved, most lenders will let you switch over to the lower rate.
Yeah.
It's not always guaranteed. Some lenders are stricter than others, but on the whole, you can switch over to a lower rate, can't you?
Yeah, a lot of people get that wrong. A lot of people think that you can't, you're fixed in once you apply.
Yeah. When the mortgage starts, you're fixed in. When you get the keys and the
start.
mortgage starts, you're fixed in. But until that, changes can be made. So have that conversation with your broker. We've seen that with some clients over the last few years where it's been volatile, saved them loads of money. In the time between they apply and when the mortgage starts, rates might have dropped by 1% and they're switching over to the significantly lower rate, which on a big mortgage can save you a lot of money.
Yes.
Covered quite a lot there. It's been quite thorough. Hopefully it's really helpful. Obviously, again, everything will be tailored to you. So if you need any help, get in touch. We can talk through your circumstances and give you our advice on what scheme you should go for. But thanks for tuning in, and we'll see you next time.